Hello and welcome back to our class on financial risk management. We stopped last week here at the start of chapter 4 on risk measurement, and we are now at a point where we've identified our risk factors. We have come up with a risk mapping that relates elementary risk factors to potential financial losses, leading us to loss distribution, and we are now given, let's call it a loss distribution L or simply X, and we are now interested in some function mu of L or mu of, okay, that's not really mu, of X that gives us some kind of risk measure, and this is what we'll be looking at here in chapter 4. We'll first talk about the principles of risk measurement. We'll have a look at axiomatic risk measurement theory, the mathematical theory behind risk measurement, and then we'll talk about some important risk measures that are frequently used in industry practice, and most notably valued risk and expected shortfall. So, in the last part, we've seen a number of risk factors, elementary risk factors like inflation, interest rates, but also prices. And all these risk factors come into play, and they are included in risk mapping that, as a result, yields us with, provides us with a loss distribution. So we now have a first understanding of what causes risk, in the sense that it is elementary risk factors that usually we cannot influence that drive risk, but we do not have any information on how probable that loss is, how high these losses can be. For this we need a loss distribution, and then of course we need to measure risk in the sense that we extract some kind of moment, some kind of in German we would say Kennzahl, some kind of metric from this loss distribution, so that we can work with these metrics in risk measurement. So that's what we are trying to do in this chapter, and at the end we'll see some frequently used risk measures from practice and some standard procedures for estimating these risk measures. We've actually seen some of these risk indicators, some risk measures or risk metrics before. For example, the so-called Greeks from the option pricing model of Black-Scholes could be interpreted as a kind of risk metric, because in the end, these metrics, these Greeks, they measure a sensitivity of the option price to various input parameters, in other sense, the elementary risk factors. So you could see, for example, the option delta measures the sensitivity of the option price to a change in the underlying stock price. So that could be a risk metric. Thus, they can be used to measure sensitivities of the P&L to changes in these input parameters of the Black-Scholes formula or the Greeks. The question is whether a sensitivity or a metric that measures sensitivity is a good risk metric. And we'll see, well, it's not really. It can be used, but in the kind of financial risk management we are trying to do, usually these metrics are not used. The Greeks are used for pricing, but not so much for, also for hedging in some cases, but you cannot use all these Greeks. So measuring risk on the basis of factor sensitivities has one disadvantage. They cannot be aggregated. So you can do this for a single investment, for a single option contract, but you cannot really aggregate these sensitivities. And I think I've explained to you the idea behind capital-based risk measurement and capital-based regulation in financial institutions. If you go back quite a number of slides to those extracts from the annual reports and the risk reports of Commerzbank, I think Deutsche Bank we've seen. You remember that, especially in banking, but also for insurance companies, financial regulators require a certain minimum amount of capital. Capital understood not just as equity, but risk capital, economic capital, or regulatory capital being equity plus X, equity plus certain parts of leverage, of certain parts of of the liabilities that will function as an emergency buffer in case of impending bankruptcy. The question now is, how do you calculate the capital, the regulatory capital, and the required capital, the capital requirements? Well, that's very simple. On the balance sheet, you can easily see equity, you can see the liabilities, so it's not really big problem to calculate the available capital in a bank, in an insurance company. But you need to calculate the required capital, your risk exposure, and for this you need risk measures. And in the end, many countries, many financial regulators require banks and insurance companies to calculate the risk exposure of all their different portfolios, of their risk classes, etc., and then allow the banks and the insurance companies to aggregate all these portfolios, all these risk exposures, to account for diversification, because diversification will reduce the required capital. So here we are again, sensitivities for like the Greeks. If you can use those sensitivities, you can easily use, for example, the option delta for hedging. And when we discuss the Black-Scholes pricing model, we will see that using the option delta is actually a fundamental part in delta hedging, which will reduce the risk of the option to zero. However, you cannot really aggregate these sensitivities. You cannot aggregate in the sense these are just partial derivatives. And you cannot aggregate those partial derivatives to come up with one aggregate sensitivity. So what we are looking for in many cases are monetary or pecuniary metrics that say, well, this is a position, 5,000 euros in risk exposure, 10,000 euros in risk exposure. So if I add them up, I have 15,000, but because of diversification, I might only have an aggregate risk exposure of 12,000. So that's what we are trying to do here, and what is done in practice. Usually it's capital based. And for this, we need certain metrics and certain risk measures. So we've seen sensitivities. Another way to do this is a scenario-based risk measurement, scenario analysis. For example, we consider set x1 through xn of risk factor changes. Those are different scenarios you might have come up with. You think of a weighting vector that will say, for example, okay, the first scenario is very unlikely, it only has a probability of like 2%. The second one is highly likely, it has 20%, and so on. We have an arbitrary risky portfolio with an associated loss operator L. And then what you do is you take those scenarios for your elementary risk factor changes, you enter those into the loss operator, and you get hypothetical potential losses. For example, 5,000, 10,000, 12,000, 2,000, and then you weight those potential losses, and you take, for example, the maximum. And then this would be your aggregate maximum portfolio risk. So the maximum loss that could arise under any given scenario under this weighting vector. So scenario likelihoods can be used as weights, and this is actually done in practice, for example, at the CME, the Chicago Mercantile Exchange, and also the Hong Kong Exchanges and Clearing, to determine margins. And this is an extract from the Hong Kong Exchange. They say, where a client maintains a margin account with the exchange participant, he will be required to pay margin on both long and short positions based on span. Span is a risk-based portfolio approach developed by the CME, and span simulates how the portfolio would react to changing market conditions. And obviously the risk exposure of a futures position is the futures price movement. And for an options position, we have price risk, change in volatility, other major factors like interest rate might be included. And span then evaluates the risk exposure of a portfolio by varying these two factors, for example, for an option contract. And then it constructs scenarios of futures price movements and volatility changes to see what the entire portfolio might look like on the next day and might lose on the next day. And then if span says, well, there's a high likelihood that you will lose a lot of money, you will be required to pay into your margin account. You will get a margin call. Again, one problem also of scenario-based risk measurement is that you get a monetary unit. You get a capital-based risk measurement, but how do you select the scenarios? Might be difficult, might be impossible, or it might simply be completely arbitrary. So because of the arbitrariness of scenario selection, this might be used as a stress test scenario. That's what it's used for in SPAN and at the CME and Hong Kong Exchange. It's rather a stress test scenario for the exchange to see, well, what's the worst case that can happen on the next day. So in the following, we'll deal with the more common way of measuring risk using loss distributions, Verlustverteilung. And in general, this is the standard way of doing this nowadays, and it relies on quantitative risk models, and it uses statistical moments taken from conditional or unconditional loss distributions. So what's the idea? The idea is to come up with your risk mapping, your elementary risk factors, combine them into a distributional model, and then model the loss distribution and then calculate a moment, also ein Moment der Verteilung, which can be the mean, can be volatility, can be kurtosis, can be skewness, can be variance, it can be a quantile. Any statistical moment could, in theory, be used for risk measurement. However, we'll see that some moments are better suited than others. And losses, how can we explain, how can we justify this approach to risk measurement? Well, first of all, we are interested in losses. We are not so much interested in sensitivities, but in the end, it's the losses that will count. Any effect on our annual profit. I might have mentioned this in risk measurement, especially in risk management, especially for small and medium-sized companies. You will see in practice, this is what is actually frequently done in energy companies in the energy sector, because they are not financially regulated. They don't care too much about capital. In the energy sector, you will often hear something like, it will have an effect on our annual profit, yes or no. This is the most important, I would say, the most important distinction between a risk that matters, a risk exposure that is important, and an unimportant risk risk exposure. Because risk management will ask, do we have to fear a significant impact on our annual profit? If yes, then financial risk management should deal with this risk. If not, we don't have to care about this. So first, losses are our focus in financial risk management. So let's use loss distributions. Certain moments of a distribution also provide monetary figures, pecuniary figures. So we are back again in our mindset of looking at capital and in a capital-based risk measurement. The loss distributions can be aggregated, at least theoretically. You can say take X and Y. X plus Y gives you a new loss distribution. And you can also look at the joint distribution, and we'll have an example for that later on. So by aggregating loss distributions, you can have a look at netting effects and diversification effects, and you can compare loss distributions to each other. That's nice. However, loss distribution and the use of loss distributions also has two major disadvantages. The first one is you need to estimate them. You need historical data to estimate your loss distribution. And actually, if you don't have data, you cannot estimate those distributions. And what is done in practice is, what you will hear a lot of times is, oh, we simply made an assumption. We simply made an assumption on the type of loss distribution. The question then is this a good assumption? Is this a realistic assumption? Sometimes industry risk managers will say, well, I only use this distribution because it makes sense. And then you can ask, why does it make sense? And you don't get an answer. That's a problem. The second way of doing this is maybe looking and using a loss distribution as a worst case scenario. This could be okay. If you say, well, in the worst case, the losses will be distributed according to, let's say, a student's t-distribution, or according to a triangular distribution, then it's okay. However, the ideal case would be to use actual data, and if you do have enough data, you still have the problem that you use historical data. You can only use historical data for estimation, and you're assuming that your distribution is stable across time, so that the distribution law doesn't change over time. If it's stochastic, however, you might use historical data that is already outdated. So always keep in mind you need historical data or a pretty good assumption, and then you need to estimate your loss distributions. The second one, risk measurement using loss distributions involves a lot of model risk. Wrong choice of mapping, wrong selection of elementary risk factors, omitting relevant risk factors, using the wrong data, making the wrong assumption, using the right data but still making an error when estimating the distribution, and last but not least, using the right assumption, the right data, doing the right estimation, but simply historical data keeps changing and the distribution law has changed over time, and you haven't accounted for the fact that you might simply have a very volatile market environment. So model risk is a huge topic and actually has only been the focus in research the last 10-15 years, I would say, after the financial crisis. So we can see that, yes, model risk is a huge problem when using loss distributions for risk measurement. So there might be some problems. However, both arguments against the use of loss distributions only demonstrate the need for careful modeling. So yes, we'll stick to loss distributions. It's not yet sufficient to use loss distributions. We still need symmetrics. We need key figures, moments, individual values, because the distribution itself only gives us an idea of what the whole situation looks like, but we need to boil it down to some key moments. So this creates the problem that we have risk ratios, risk metrics, risk measures, and different risk metrics could be differently well suited for risk measurement. And this question is and was addressed by what I call axiomatic theory of risk measures. It's actually the part of mathematical finance that looks at risk measurement from a very mathematical point of view. And this is chapter 4.2. So let's have a look at axiomatic risk measurement theory. Now, this is all due to one paper by Arzner, Delbin, Eber, and Heath. It's called Coherent Measures of Risk, and it was published in, I think, 2000 or 1999 in, I think, Mathematical Finance. Coherent Measures of Risk, and published in Mathematical Finance. That's the name of the journal. So have a look at this one, quite interesting. And what they did is they saw in 1999, so a long time ago actually, they saw that industry practitioners were using different risk metrics. They were using quantites, they were using volatility, and so on and so on. And they sat down and said, okay, we need to have a mathematical framework for risk metrics. And what they did is they actually said, okay, the starting point is a distribution. We have a distribution X, and this is stochastic, and we need to have a look at some function mu of X. So which properties should this function mu have in order for us to say this is a good metric or this is a bad metric? So they generalized the risk measurement from a mathematical point of view. They used standard definitions, I would say, from probability theory, actually from measure theory. And they said, okay, we first need to define what a risk measure is, and then define a set of axioms that each risk measure should fulfill to be economically sensible. And these axioms can then be used to assess known risk measures, and we'll see how, for example, volatility, how the expected value, how quantiles, how these fare under these axioms. I'll only discuss the brief highlights of this theory, but actually the paper isn't that complicated. Even if you haven't studied mathematics, you should have a look at this one. It's quite interesting because it's just one paper that has led to a huge strand of research in mathematical finance. So we're starting with a probability theory, and actually what we are most interested in is random variables defined on this probability space. We assume that we have a subset of all random variables. This is the set of all random variables, which is a convex cone, meaning that if you have two random variables, in German it's konvexer Kegel, meaning what? If you have, let's make this as a graphic. Now, if you were to say this is some space, and if you say we have this point and we have this point here, you would immediately see that the if we were to draw a line between the two, give me a line here. If we were to draw a line, okay, this could still be in the set. If we have 2 points like this, let me use this here. If we have a point here and here, you would see that, for example, a direct line between the two would not be in the set, because suddenly we have a part, and let me just show this here. In this area, the line leaves this set. So in this sense, we could say that if we have this set is not closed under convex combinations. Yeah, the direct line between these 2 points is a convex combination, and this set is not closed under convex combinations. And actually we will require sort of this here. We have a set that maybe looks like this. We have 2 risks here and here, and we require that the sum of those 2 risks and a positive scaling of risk is again in this set. Ja, das ist also ein konvexer Kegel, was eigentlich nur bedeutet, dass wenn Sie 2 Punkte haben, 2 Objekte, wir haben jetzt hier Zufallsvariablen, wenn Sie 2 Zufallsvariablen haben, wenn die Summe wieder in M liegt oder wenn Sie ein Risiko nehmen, eine Zufallsvariable, mal 5, mal 20, mal 5000, wenn das alles wieder in M liegt, also ein Produkt mit einem positiven Skalar, wenn das wieder in M liegt, dann ist das ein konvexer Kegel. Hier oben an dem Beispiel sehen Sie das mit Konvexkombinationen. Das ist im Grunde genommen ist es das, dass Sie also 2 Punkte haben, und wenn Sie die beiden Punkte konvex miteinander kombinieren, dann ist das entsprechend hier auch eine konvexe Menge, und dann wäre das unter Konvexkombination abgeschlossen. Was man natürlich schon sehr schön sieht, dieses obige Bild hier, diese Menge kann natürlich nicht konvex sein, weil sie ja gerade hier konkav ist. Also, wir kennen konvexe Polyeder, das ist genau das Beispiel, was es nicht ist. So, das wäre jetzt ein konvexer Polyeder, und hier verlangen wir einen konvexen Kegel. That's a convex cone. Okay. So let's continue. What is risk measure? By a risk measure, we generally understand a real valued function, mu, defined on the set, on this convex cone of all real valued random variables. And let's say that one risk is L. So L is an element of M. So this is a risk. It's einfach ein Risiko, eine Zufallsvariable. And we interpret mu of L as the required capital sum which must be allocated to L to make L acceptable to some kind of internal or external regulator decision maker. If the risk capital sum mu of L is smaller than the 0, the risk is acceptable and you can actually take money out without making the risk unacceptable. So this could be actually a bank account. If you have 1 million on your bank account, you can withdraw 1 million euros without making the bank account being an unacceptable risk. If it is positive, you need to put some money in to make it acceptable. So, say this in German again. Die Definition eines Risikomaßes hier nach Arzneimittel, Bern, Eber und Heath ist einfach, ganz einfach so, dass man sagt, ich unterscheide Zufallsvariablen in akzeptabel und nicht akzeptabel. Durch zum Beispiel den Vorstand, durch die Aufsichtsbehörde, durch den Staat, durch den Gesetzgeber. Und ich kann jedem Risiko eine Kapitalsumme zuordnen. Und das macht diese Funktion νη. νη ordnet jedem Risiko eine Kapitalsumme zu. Und der Vorteil ist dann, dass wenn die Zahl positiv ist, dann muss ich das Geld einzahlen, muss also im Grunde genommen Kapital bereithalten. Wenn umgekehrt νη von L, wenn das negativ ist, dann ist das Risiko lange, lange noch akzeptabel und ich kann sogar Geld rausnehmen aus der Position. Das wäre zum Beispiel mit dem Bankkonto der Fall. So this is the general definition of risk measure. Now let's look at some axioms. The first one is translational invariance, Translationsinvarianz. This risk measure nu is called translational invariant if for all risks L and each L, the following holds. If you add an amount of capital small l to capital L, then what results is you have the risk capital of capital L plus small l, which states in an economic sense that adding a risk-free amount small l reduces the risk or the required risk capital by exactly this amount small l. In other words, if you add mu of L to the position, this will hedge the position and reduce it to zero. Ich sage das kurz auf Deutsch. Translationsinvarianz bedeutet vor allem in der Geometrie natürlich, dass wenn Sie ein Objekt haben, ich gebe jetzt mal ein schönes Beispiel. Wenn ich jetzt, stellen Sie sich einfach mal vor, nehmen Sie Ihre Hand, nehmen Sie irgendein Objekt, nehmen Sie jetzt zum Beispiel den Stift hier und schauen Sie mal, wenn Sie den Stift im Raum bewegen, dann ändert sich seine Form nicht. Sie sehen also, das Objekt ist im dreidimensionalen Raum, ist hier Translationsinvariant. Sie können also das Objekt hin und her verschieben, genauso wie ein Vektor oder genauso wie eine Kugel oder was auch immer. Und das Objekt verändert seine Form nicht. Das ist damit gemeint, Sie haben ein Risiko, also simple lineare Algebra hier, eigentlich diese ganze Theorie. Und wenn Sie das Objekt nehmen, nämlich das Risiko, und Sie fügen einfach einen sicheren Betrag hinzu, dann verändert sich der Betrag, den Sie brauchen, nicht. Ja, das ist Translationsinvarianz. Und jetzt gebe ich Ihnen, wenn Sie hier live vor Ort sind, dann sehen Sie ja meine Kamera, jetzt gebe ich Ihnen mal ein Beispiel dafür, warum das nicht so trivial ist, nämlich wenn Sie in der Geometrie etwas Dreidimensionales auf zwei Dimensionen projizieren, das was gerade jetzt hier mit der Webcam passiert, jetzt schauen Sie sich mal an, das Objekt, der Stift, na, und Sie sehen, plötzlich in Ihrer Wahrnehmung an der Webcam ist das Ganze nicht mehr Translationsinvarianz, weil wenn ich von 3 Dimensionen auf 2 Dimensionen projiziere, dann wird natürlich hier durch die Projektion ist das Ganze nicht mehr translationsinvariant. Ne, weil der Stift ist jetzt klein, wenn ich näher dran halte, ist er groß. Ne, sehr schönes Beispiel dafür, wie Sie hier sich die Translationsinvarianz erklären können. Okay, so the risk measure, first axiom, needs to be translational invariant. Moving the risk by adding or subtracting a risk-free amount L doesn't reduce the actual required risk sum of L. It only reduces the aggregate risk sum by exactly this amount small l. This is the first axiom. The second one is subadditivity. The risk measure nu is called subadditive if we have two risks, L1 and L2. And if we add L1 and L2, this is actually here, this is the portfolio on the left-hand side. The risk capital of the portfolio needs to be smaller than the sum of L1 and L2. Meaning what? If the risk measure is subadditive, it accounts for diversification. So a subadditive risk measure takes diversification into account. If this is violated, if this could be the case, then this risk measure doesn't make too much economic sense. Subadditivity, diversification. The third one is positive homogeneity. Positive homogeneity means that if we have a risk L, capital L, and a factor lambda, the risk capital of lambda times the risk is exactly lambda times the risk capital of L for itself. Simply what? If we have one stock, we have 100 risk capital. If I buy 10 stocks, we need 1,000 euros in risk capital. So if we scale our portfolio up or down, if we have a higher or smaller investment, larger or smaller investment, then positive homogeneity means that we need exactly 10 times the risk capital, 5 times the risk capital, only half the risk capital. This is not, it might actually sometimes be the case that if we have 10 stocks, that we actually need 2,000 because of liquidity concerns. That's why in some cases we use a slightly different axiom. The fourth one is monotonicity. Monotonicity means that if we have L1 and L2, two risks with L1 smaller or equal than L2, then the following is correct. L1 and L2, the risk capital should also be smaller or equal than for L2. However, keep in mind that we have to make sure it looks like this for all states. If, for example, we have L1 and L2, we have three states, L1, 1, 2, and 3. And let's say we have potential losses, let's say 3, 5, and 2. And L1 looks like this. Then, yes, L1 is larger than L2. If, however, it looks like this, then this is larger, and this is larger. And you can see L1 is not strictly larger or smaller than L2 because in one state it changes. So in every state, L1 needs to be smaller or equal than L2. Say this in German again. Es muss hier natürlich in jedem Umweltzustand so sein, dass L1 immer kleiner oder gleich L2 ist. Es geht nicht, dass in dem einen Zustand mal L1, in dem anderen Zustand mal L2 kleiner oder größer ist, sondern wenn, dann muss für die Verteilung in jedem Zustand L1 immer kleiner oder gleich L2 sein. Und dann ist natürlich das benötigte Risikokapital auch entsprechend kleiner oder größer als das andere. Okay. That's the fourth one. And if now a risk measure mu satisfies all four axioms, monotonicity, translational invariance, subadditivity, and positive homogeneity, then it is called coherent, ein kohärentes Risikomaß. And this restriction to a convex cone is theoretically important, but in practice we don't need that. So that's a coherent measure of risk. I told you that the positive homogeneity property is sometimes a little bit too restrictive because in industry, it could be if you buy up all stocks of one company, actually your risk is higher because the scaling factor might be 10, but because of liquidity concerns, because you're a high stakes investor, you might not be able to liquidate your position so easily. So this would mean that in some cases, actually, if you buy lambda times the stock, then it should be higher than the initial investment. And this is done by looking at so-called convex risk measures. So it's called convex if for all risk L1 and L2, we have that mu of lambda L1 plus 1 minus lambda L2 is smaller or equal than the convex combination of the two. Then this is called a convex risk measure. Okay. Now this seems to be very theoretical, and it is. This is a pure mathematical theory of risk measurement. However, it's quite interesting to see how this actually influenced our thinking in financial economics on risk measurement, because one after one, all major risk metrics like value at risk, expected shortfall, volatility, and so on, were checked whether they actually satisfy these risk measure axioms, and one could see that some famous risk metrics actually they don't fulfill one or two of these axioms. On the other hand, this also led to the development or improvement on other risk measures, and they are all used in practice, so it's good to keep in mind those shortcomings and disadvantages of those risk metrics. Okay. So I think we can stop here for today. If you have any questions, just stay in the Zoom room a little bit longer. I would say you can have a look at the next two subsections where we'll talk about famous risk measures from practice, valued risk, expected shortfall. And then next week we can continue our discussion here at this point by looking at VAR, expected shortfall, and some standard procedures for VAR calculation. Okay, so thank you very much for your attention. And if you have any questions, please just stay in the Zoom room. Thank you.